Good day, ladies and gentlemen. Today, I'm joined by Hlelo Giosi, or as he is more affectionately and simply known in the industry, Lo. He is the CIO of First Avenue Investment Management, a firm he founded after a long and successful career with corporates such as Investec and Stanlib. So Lo, to start us off, why is there the belief that one can no longer invest on the basis of style, specifically quality, in South Africa so pervasive?
Alex, this is a great question to start us off. By the way, price discovery on the stock market is really important for participants to trade freely, express their capability, express their styles, and express their biases in order to extract alpha. But the Johannesburg Stock Exchange has been weakening in the elements that contribute to price discovery. One of those elements is the number of stocks or number of shares on the stock market has shrunk materially. With it, the number of sectors on the stock market has shrunk materially. So the supply of stock and the supply of sectors is in hibernation. On the other hand, the number of foreign investors and the amounts of money they command has only risen over time. Coupled with that, domestic managers who are large command more and more of the market share of trade and assets under management anyway on the local stock market. So large managers are confronted by concentration in number of companies and concentration in sectors. This inhibits price discovery. But it inhibits price discovery for large managers, not necessarily for smaller and mid-sized managers. The latter, smaller and mid-sized managers, can still express themselves stylistically where large managers struggle. This struggle has been couched by large managers to fund allocators in terms of style agnosticism, meaning that you cannot generate alpha if you have a style bias. It's obviously self-evident in large managers. As a result, fund allocators have turned around and convinced asset owners not to build portfolios based on style, because it is impossible to generate alpha based on style in the local market. This to us is a disservice to the industry. By walking away from style, what the industry is doing is walking back, if not regressing back, to the stone ages of assets of investment management, away from the golden age of style-biased or style-based management.
So Lo, are you saying that fund allocators and asset owners should be insisting on style-based investing?
Let's look at what fund allocators and asset owners are trying to achieve. They really are trying to optimize between systematic risk, that's macro risk, and systemic risk, that's micro, fundamental company-specific risk. And the reason they do that is to extract about as much alpha as possible en route to the lowest amount of risk, taking the lowest amount of risk possible. That is diversifying risk. And the best way to do that is to utilize style. If you don't utilize style, you have style agnostic managers right across the economy, right across the market, who mimic the benchmark. And so when the benchmark goes up, everyone does well. There's not much difference in outcomes. When the benchmark goes down, when the market goes down, everyone goes down. This is a disservice to the end client. By diversifying risk, what you need to do is to take the defensiveness, for instance, of quality, because quality concerns itself primarily with systemic risk. And then you can take the cyclical nature of value on the other side, value style, which concerns itself mostly with systematic risk. Value does really well in an up market, quality does really well in a down market. Quality gives up some on the upside to protect on the downside. Value gives up some on the downside to gain more on the upside. Blending these two styles together gives you a much smoother outcome than you would get if a manager was style agnostic. If every manager is now managing risk, who is maximizing value? If managers don't do that, who is left with that remit to maximize value if everyone is optimizing risk, from manager to fund allocator to asset owner?
So it's often said that quality is in the eye of the beholder. Could this be a disadvantage of quality, that it has such a wide interpretation? And could this also be why fund allocators are so hesitant to use it as a risk diversifying building block?
Let's think about things this way. Fund allocators are simply reticent to choose an approach that defines quality appropriately. Think about it this way. There cannot be multiple ways to interpret quality, because there also aren't multiple ways in which companies can extract value from the economy. Let's agree on a few things, just so that you see this example really well. Advotech is a high quality company. First Rand is a high quality company. Capitec is also a high quality company. Quilter is a high quality company. These companies are mature companies. What is really most open to them at this point in time is more process engineering than product innovation. These are large companies. They have a very limited set of opportunities to extract productivity from uncertainty. How is it that they have a limited set of opportunities to do so, but managers who invest in them have multiple interpretations of that opportunity set? There has to be an alignment between the opportunity set open to management to harness uncertainty and portfolio managers and investors who invest in these companies for that opportunity set. It cannot be so wide open for investors and so constrained for management. So the true answer is that, logically speaking, there is a limited set of interpretation of quality in First Rand, in Capitec, in Quilter, for instance, as there is a limited opportunity set to interpret the productive uncertainty that asset managers see in companies. This definition obviously expands when a company is smaller, like We Buy Cars. It is at the beginning of its J-curve. As a disruptor, you are more focused as a company, like We Buy Cars, on product innovation, acquiring the entire value chain and integrating it in order to respond to client needs as an industry is getting set. But in mature companies in a set industry, the opportunity set is mostly process engineering, and it's very, very limited. Feedback from clients is not as varied and as frequent in large companies as it is in smaller companies. So we disagree. The quality is in the eye of the beholder, rather. It is just the same for managers as it is for executive management of companies.
So Lo, moving on to your own portfolio now, the First Avenue local equity portfolio. It has recovered extremely well over the last period, especially after the relative underperformance of quality in the South African equity market between 2017 to around about 2021. Now, there must have been very uncomfortable periods during this time. How did you manage to maintain your quality bias?
Well, Alex, indeed, it was a very, very difficult time. And during that process, we tinkered with a lot of ideas. Some of the ideas, as we just spoke now, related to, does quality still work in South Africa? It's a commonly held belief which, thankfully, we do not subscribe to. We considered it, but we don't subscribe to it. We've continued to focus on our core capability, which is addressing systemic risk. Fundamental analysis is extremely critical when you're a quality investor, because you really generate alpha from two sources. Number one, share prices gravitating to your valuation, And then number two, a company renewing corporate value consistently over time to extract compounding. So that was extremely critical, that 85% or 90% of the portfolio does that. But what we have realized is the counter move to investing in quality is the rate at which systematic risk overwhelms systemic risk. So when we had quantitative easing, that risk was so high that regardless of what we did addressing fundamental systemic risk in the portfolio, it was so overwhelming. So in order not to get too much left behind and wiped out by systematic risk, we figured out how to invest in the one asset that addresses systematic risk: gold equities. As you know, gold equities are highly leveraged to the gold price. Whilst we are underweight gold equities, we still stock pick within that sector of primarily three companies. Our preferred holding is Anglo Gold, we are neutral Gold Fields, and we do not own any Harmony. That to us is a pecking order of quality in the gold sector. In the past, we held zero of gold equities. Today, as you can see, we are marginally underweight. We just don't hold Harmony. So we've addressed both systemic risk to the tune of 90 to 95% of the portfolio, such that if the market falls, our portfolio remains defensive, but we also capture upside stemming from addressing systematic risk through gold holdings, as is the time now when gold is running. Our portfolio is doing really well because we've plugged that hole.
But are you able to give us examples of your high quality portfolio that addresses the systemic risk?
This is the part that we're really excited about when we discuss the fundamental reasons why we own high quality companies in the portfolio. We mentioned earlier that it is not in the eye of the beholder that Bidcorp, for instance, is a high quality company, same as First Rent, same as Capitec, same as Outsource, same as Avitec, same as Quilter. These are all high quality companies that we all agree are in the eyes of all quality investors. One of the most important points to recognize about these sort of companies is that they have over time generated significant earnings growth, and they funded the assets that produce those earnings through mostly equity rather than debt, so they are relatively light on debt on the balance sheet. They've generated revenue growth, but they've generated earnings growth at a rate faster than revenue growth. In turn, they've generated cash flow growth at a rate faster than earnings growth. And where all three go, share prices go. And where share prices go, ratings go. So after a long time of compounding, you look at these companies trade at much higher multiples on a consistent basis. And that is only a function of compounding as they continue to dominate the profit pool in their industry. We like these sort of companies. When you look at them now, a company like Capitec still has a lot more product innovation in it because it doesn't have any legacy systems like other banks. On the other hand, a company like Clicks has a lot more process engineering in it because it's such a mature company but dominant in its market segment. Right? Now we're very excited that we've recently added a company called We Buy Cars to the portfolio. And that company is at the beginning of formalizing an informal sector, which is the digital car trading, car auctioning sector, to buy and sell a car digitally and through auctions. There's significant amount of feedback the company gets from customers, which it has to put into how it operates. So it vertically integrates its operations, and it's at the beginning of extracting profits from that level of uncertainty. It has a long runway to get to 20, 30, 40, 50% penetration in replacing the regular car dealer. It's generating network effects which we think will stand the company in great stead. So the portfolio, we are really excited about its prospects, given the companies that are at different places in product innovation versus process engineering, and we'll look forward to continue stewarding your capital.